Ladies and gentlemen, good day and welcome to the Kalpataru Power Transmission Limited Q3 FY23 conference call hosted by Emkay Global Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhineet Anand from Emkay Global Financial Services. Thank you. Over to you, sir.
Thanks, Darwin. Good afternoon, everyone. I would first like to thank the management for giving us this opportunity to host the call. I will hand over the call to Mr. Vishesh Pachnanda, Vice President and Head Investor Relations. Over to you, Vishesh.
Thanks, Abhineet, and thank you for hosting the call today for us. A very good evening to all the participants. This is Vishesh Pachnanda. I'm pleased to welcome you to the Kalpataru Power Transmission Limited earnings call for the third quarter and for fiscal year 22-23. We have with us today the management team represented by Mr. Manish Mohnot, the Managing Director and CEO. Mr. S.K. Tripathi, Deputy Managing Director, Mr. Amit Upleshwar, Director, and Mr. Ram Patodia, President and CFO. We'll start with a few minutes of opening remarks by Mr. Manish, and then we can open the floor for Q&A. With that, and without any further delay, over to you, Manish, sir. Thank you.
Thank you, Vishesh. A very good evening and a very warm welcome to you all for joining the earnings call of Kalpataru Power Transmission for the quarter and 9 months ended December 22. Before diving into our performance for Q3, I would like to inform you that the merger of JMC project with Kalpataru Power Transmission was dated in the month of January 23. The scheme of amalgamation has been effective from 4th January 23. The record date for allotment of shares was 11 Jan 23 and newly issued shares were listed on 1st February 23. The merger was completed before the stipulated time against our earlier expectation of March 2023. With the completion of the merger, KPTL has become one of India's largest listed diversified engineering and construction company with a global presence and order book including L1 of nearly 46,600 crores. A milestone for us, and more importantly, the merger strengthens our core EPC business and places us favorably to take advantage of the large spending happening globally and in India towards energy transition and civil infrastructure development. We now possess the necessary capabilities and flexibility to rebalance our growth strategy given the dynamic business environment. Our diversified business along with proven competence in domains of design, engineering, construction, project management and manufacturing will help improve and strengthen our market position going forward. We are now working on the integration of banking, IT, HR and procurement initiatives in order to fully leverage and benefit from the synergies arising out of combination of these two entities. These benefits are expected to start kicking gradually from Q1 of 24 onwards. Coming now to the financial and operational performance for Q3 and 9 months for the financial year 23, let me put forward that with the completion of the merger and the appointed date being 1st April 22, our standalone results represent the combined standalone financials of erstwhile JMC and KPTL. We have delivered standalone top line growth of 10% in Q3 and 12% for 9 months financial year 23. The growth has been led by robust execution and a healthy order book in the domestic and international business. Our consolidated revenue has grown by 3% in Q3 and 8% for 9 months 23 to reach rupees 11,479 crores. It's worthwhile to note that we were not able to book some part of the revenue in the last few days of December 22 and the initial days of the month of January 23 owing to the procedural delays and modalities arising out of the merger due to replacement of contractual documents. All such contractual documents have been replaced across all projects. However, we still expect standalone revenue growth to be closer to 15% and consolidated revenue growth in the range of 12 to 14% for the full year 23. Our standalone EBITDA margin continues to remain in the range of 9% for Q3 and 9 months for 23 despite enormous volatility in commodity prices and cost pressure. The underlying strength and focus of our business model on profitable growth are clearly demonstrated in our performance. Our EBITDA margin at a consolidated level were 9.1% for Q3 and 9% for 9 months 23. Our standalone PBT before exceptional items stood at rupees 166 crores with a margin at 4.7% in Q3 23. For 9 months 23, PBT before exception stood at 520 crores with margins at 5.2%. Our standalone reported PAT stands at 111 crores in 23 and rupees 379 crores for 9 months FY23. Our standalone net debt stands at rupees 2,053 crores. The increase in net debt is primarily on account of incremental working capital requirements in select projects and higher capex for new orders largely in the international markets. Our standalone net working capital days stand at around 134 days as on December 22 compared to 126 days in March 22. Our net debt level is expected to remain in a similar range for Q4 23. Getting into next year, we believe debt levels to reduce as we expect better collections, speedier project closure and proceeds from divestment of non-core assets, particularly indoor real estate. We have witnessed strong order momentum with YTD order inflows of rupees 19,487 crores. Additionally, we have L1 position of rupees 5,200 crores. Our current order inflow including L1 stands at rupees 24,687 crores against a targeted order inflow of 21 to 22,000 crores for full year. Our order book including Linjemontage and Fasttel stands at an all-time high of 41,442 crores as on 31st December 22. Coming now to the individual businesses. In the T&D business, our revenue remains subdued largely on account of lower backlog at the start of the financial year. However, with the improved tendering activity and business development efforts, we have secured projects of over rupees 7,500 crores till date in 23. With the new orders getting under execution, we expect growth to kickstart from Q4 of 23 onwards. Our Sweden subsidiary Linjemontage has delivered revenues of 279 crores in Q3 and rupees 801 crores for 9 months 23. Our EBITDA margins for Linjemontage remain at comfortable levels in the range of 8 to 9%. Our Brazil subsidiary Fasttel has reported revenue of 95 crores in Q3 and rupees 316 crores in 9 months 23. With an order book of rupees 810 crores at the end of December 22. We continue to focus on project closures and strengthening our business in order to improve our performance in Brazil. Our B&F business has delivered revenue growth of 30% on back of robust execution and strong order book. Our YTD order intake stands at rupees 3,395 crores and order book stands at rupees 8,088 crores. We continue to strengthen our market position with repeated wins from large existing clients and additional new institutional clients. We are confident to continue the growth momentum in our B&F business on back of our robust capabilities and improved business visibility. Our water business achieved strong growth of 41% aided by record order book and healthy execution. Our order book stands at rupees 9,874 crores for the water division. Currently, we are executing over 30 projects in India and the overseas market. The continued thrust by the government and increased budgetary allocation for JJM augurs well for this division. Our railway business was subdued marginally due to a lower order backlog. We are now focused on project closures and improving our market standing in segments like metro rail, semi-speed and high-speed rail. We are positive with the recent allocation in budget by government for improving and strengthening the railways infrastructure. Additionally, we are focusing on international markets and expect some breakthrough in the next year. In the oil and gas business, we have reported revenue growth of 7% in Q3 23 and we have secured orders of around rupees 1,420 crores. Our bidding activity remains very positive in India, MENA and African markets. We now qualify to bid in 6 to 7 countries and expect our international reach in the oil and gas business to improve in coming quarters. In the urban infra business, we reported strong growth in Q3 23, which was driven by improved execution of new projects. We have also successfully commenced execution of the Maldives Integrated Airport Development Project. We expect our urban infra business to contribute meaningfully to our growth in the coming year as significant investments are geared towards improving our capabilities. In case of our road BOOT projects, revenue continue to be in the growth trajectory as it has reached to rupees 52.6 lakhs per day in Q3 23 compared to rupees 46.3 lakhs per day in similar quarter last year. We have invested rupees 60 crores in 9 months 23 largely to fund repayment and service our debt. We are at final stage of completing restructuring of WEPL. We have appointed advisors to evaluate the sale of our road boot assets again, given improved performance on traffic and tolling front. We are entering the last quarter of the financial year with a strong order book and a healthy tender pipeline across all our businesses and key markets. Additionally, the benefits arising from the merger integration with JMC will help us to improve our growth and profitability in the coming quarters. Currently, we are in the midst of a detailed planning and budgeting exercise for the next financial year. And given a strong order book together with healthy tender pipeline, it appears that we should be able to deliver revenue growth in excess of 20% and improved EBITDA margin in financial year 24. We will come back to you on the exact financial 24 guidance during our full year results later in the year. With this, I would request the moderator to open the lines for Q&A. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
On the integration of JMC now. So have we started?
Sir, there was some loss of audio. I request you to please repeat your question.
Yeah, so I just want to understand that integration with JMC. So have we started realizing improved profitability or savings? Did we recognize anything in this quarter?
So Parikshit, the benefits are coming on different accounts, but on the financial side, the savings would start maybe from Q1 of next year, primarily on the banking and interest costs, because there's a big difference in the cost for both the organizations. You started the process of discussing with banks and, it's at very advanced stage. We believe by March that should be done. So on the banking and interest cost, it would start from Q1 of next year. On the process of integrating the capabilities and bidding for large projects, we've already started working that out, and that's helping us win some large projects. And also on international projects, taking, a lot of our civil business international, that's also started. But to answer your question directly on the financial side, I think the benefits you'll start seeing from Q1 of 24.
Both on the financial side and the operational side, and plus release of our other guarantees, fund-based limits because of the integration. So what kind of total savings we are expecting next financial year out of this merger? Because interest rates have also gone up, so I don't know how much you can really save. If you can quantify the current interest rate, that will be helpful. And what kind of limits will get freed up for us post this integration on fund and non-fund based side?
Sure. So on the limit front, I think now as a merged entity, we have enough limits to look at growth of 20% plus for the next 2 years. So we're not worried both on funded and non-funded. During our merger exercise, we had calculated a benefit of closer to 100 crores coming out of the merger exercise, both on interest cost and a few other areas of cost rationalization. We believe that easily 50 to 70 crores reduction we should see in interest getting into the next year itself on the merged entity.
Okay. So my second question is on the growth outlook now. So now we have JMC with us, we have fortified our balance sheet, we have expanded network capabilities, qualifications. So what kind of opportunities it opens up in the international market? So how do you see your prospect pipeline multiplying now on account of this integration or merger?
So Parikshit, today our order book visibility of around 46,000 crores, is good enough to provide us a healthy growth getting into the next 2 years, right? Please remember that our order book has actually doubled in the last 2 years on a merged entity basis, right? So with this order book, we're confident that we'll be doing a minimum of 20% growth getting into the next year. Is it going to be very significantly different than that in terms of the upside? I would say no. It will be in the range of 20 to 21, 22%. We are doing the final prints now, and we'll come back to you. But 20% plus growth is visible for the next 2 years.
It's coming more from JMC side that JMC is now going international. So the brand name of Kalpataru, Unified Kalpataru. So what kind of possibilities it opens up on the ordering front and this 21 to 22,000 crores of inflows. So how do you see this growing for the next year on that also?
So, Parikshit, it's important to understand that now as a merged entity, all divisions are looking at a growth of closer to 20%. Except for the railway division, every other division, whether it is water, whether it is B&F, whether it is T&D, or whether it is oil and gas, all are looking at growth of 20% plus in the next year, given the visibility of order book.
So order inflows is also expected to grow by 20% next year, like 20,000.
We will come back to you on that because current year against our order inflow target of 21,000 crores, we believe we will be landing up at 25,000 crores. So our revised order inflow target for next year will come back to you along with the year-end results.
Okay. Okay, sir. That was my question. Thank you and all the best.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1 on your touchtone phones. We have the next question from the line of Akshay Kothari from Envision Capital. Please go ahead.
Thanks for the opportunity and congratulations on good set of numbers. So I could not understand the reason for the lower execution which you mentioned. Can you please elaborate it?
The primary reason for lower execution in the last week of December and the first week of January was because on a lot of projects of JMC, primarily with government agencies and a few railway projects, we had to replace the old guarantees of JMC with the guarantees of the new erstwhile company. Also, a lot of these PSU entities have their own processes of giving the approvals, right? While the NCLT approval had come, there would be certain documentation, they would ask for certain additional information and all of that. It's a process which is very normal, but we were doing it for the first time. So we did invest a few weeks in getting that done. While we speak, all projects we have done that. And during that process in the last week of December and the first week to few weeks of January, few projects suffered in terms of execution as well as collection.
So now they have normalized, right?
Yes, as of today, all projects are normalized.
Okay. And sir, in the recent credit rating update, it was mentioned that around 100 crores of maximum loss from the road projects could be around 100 crores. So we have booked an ECL of around 2 crores in this quarter. So do we expect any significant ECL in the coming quarters or in Q4 as well?
So we do not, I don't think the ECL has come out of the road projects, just so that we are very clear. ECL as a process comes out of the overall debtors which are overdue in nature. As far as our road projects are concerned, we don't expect any further loss to come. We've just taken a 2 crores hit on KEPL, right, which is on account of expenses which have been incurred there. It's just the amount of 2 crores, which is on account of statutory liabilities and some creditor payments which were overdue in nature, which we have paid now.
Okay. So you did give a guidance of FY24, but in Q4, do we expect very good revenue execution and what could be the margins we could see?
So in Q4 also we are expecting revenue growth in the range of 15% and that's what we have guided. We do not see margins falling drastically. We do not see it going up also. It should be in the range of same 8.5-9% at a standalone and at a console in the range of 9%.
Okay. And sir, my last question would be on the effective tax rate. So it's around 30-31% currently in this quarter as well. So as far as I am aware, it was around 25.2 or guided as 25.2. So can you just clarify on what would be our effective tax rate, because a lot of jurisdictions come into play and so.
So the effective tax rate is close to about 30% plus because there are certain countries where the tax rate is much higher than the Indian tax rate. So we'll have to pay taxes in those countries. So the tax liability of those countries also gets clubbed over Indian tax liability. Plus there are certain losses on which we have not created deferred tax asset, because we don't have a certainty at this point in time how we'll generate that kind of gain to offset those losses. So that's why our effective tax rate is close to 30-31%.
Okay. Okay. That's it from my side. Thanks a lot and all the best.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Kaushik Podar from KB Capital Markets. Please go ahead.
Yeah. Next year, what is the kind of margin you are looking at? I mean, right now it is around 9.5% of the console basis. So what is the margin you are looking at with a 20% top line growth?
So Kaushik, while we are doing our detailed business plan, we do not see a significant reduction in margin. We expect margins to be at a similar level. We would be coming back with a refined number when we give the year-end numbers.
On the margin front as well, is it?
Yes. But it shouldn't. You shouldn't expect a significant downfall or incremental. Our first level analysis is that it would be in the range of 8.5% to 9% only.
And with the expected 50 to 70 crore of interest rate reduction, do you see the PBT level margin going up?
Yes, we are targeting PBT levels to be in the range of closer to 5%. That's what our target getting into the next year. And we will do a final print on that and come back to you.
As of now, it is less than 5% as of now? I haven't calculated.
It's around 4.7, on a 9-month basis.
Okay, so you see a 0.3 to 0.5% bump up, right?
Approximately 0.3, 30 basis points.
0.3%. Okay. And this suddenly, this 20% you are thinking of this year, next year and year after next, that is the kind of projection you are giving. So do you need some amount of additional manpower for that, or will it be how much percent increase in manpower cost you think for those 20% revenue growth for the next 2 years?
So, we have been continuously building manpower over the last few years, right? And today, the integrated manpower strength of more than 7,800 people, we believe we might not need so many people to come in at a HO, RO or project site level. As far as subcontractors are concerned, definitely we'll need more subcontractors to work with us. We will definitely need more manpower on the international projects where, we have had a huge exponential growth coming up in the last 12 months in case of order book. And that's something, so water division and international projects is something where we might have to build additional teams. Water because we've entered a few more states in the last 3 to 6 months and the order book is very high. International because we've covered more geographies and the order book has grown. So with that, I think these 2 divisions we'll be building. It's a continuous exercise, not be a constraint to achieve our revenue growth.
Okay. And my last question, you have given a projection of $3 billion by 25. That means if you're talking of FY26, right?
So we are talking of FY25. If you grow at 20%, we are there.
24-25 or 25-26?
24-25.
Okay. Thank you. Thanks a lot.
Thank you. Participants who wish to ask a question may press star and 1 now. We have the next question from the line of Amit Anwani from Prabhudas Lilladher Private Limited. Please go ahead.
Hi, sir. Thank you for the opportunity. So my question is about the domestic international mix. If you could highlight segment-wise and post-merger, what kind of domestic international mix, if any assessment you would have done, you're looking for over the next 2 years based on the order book?
So, I'll just divide this into 2 components. One is the order inflow for the current year and second is the order book. If you look at the order book today, our order book of around 41,400 crore domestic is 56% and international is 44%. If you look at the current year order inflow, domestic is 60%, international is 40%. We believe that the opportunity on international, at least on 3 or 4 segments, which are primarily transmission, urban infra, oil and gas, look very attractive. As far as the domestic market is concerned, whether it is transmission or water or B&F or railways, all of them look healthy. Going forward, we believe, we should be in the range of 55 to 60% on domestic and around 40 to 45% on international.
Right. So, so in the current book, just wanted to understand how much, at least in like water and T&D, how much is domestic, international?
So on the T&D side, if you look at our total order book, which is around 14,376 crores, I think around 70% plus is international. To give you an exact number, out of the 736 crores, around only 2,000 crores, which is domestic, everything else is international.
Right. My second question is...
On the 90% plus is international. There's only Mongolia and Maldives, which is international. Everything else is domestic. Sorry. And the water 90% plus is domestic.
600-700 crores.
Yeah. So my question is next question on railways and T&D. You highlighted T&D has seen a decline because of lower opening order book, and railways also have been muted. So any order pipeline visibility would like to highlight in domestic market, considering there have been few announcements in budget also for FY24 for T&D and railways?
Yes. So if you look at T&D, what happened the first 6 months was a lot of projects got delayed. Whether it was projects on solar related integration, whether it was Leh Ladakh, whether it was a lot of Rajasthan, Gujarat projects, a lot of them got delayed. In the last 3 months, we've seen a lot of projects open up, and while we speak, we are relevant on 3 or 4 large projects. So on the T&D front, we believe that business should be coming back to a 10% or more growth getting into the next year. Because a lot of these orders where we are L1, one of them is a state and a couple of them are power grid. We should get the orders and the execution would start into next year. As far as railway is concerned, we have not grown our order book consciously because focus is a lot more on closure of projects and completing old projects because the order book there was very healthy at the beginning of the year. Now with the new budget, hopefully we'll see a lot more tenders coming up, and that's when we strategize our growth plans for the division.
Right. Last question on the synergy benefits. So what we are targeting, how much percentage savings we are targeting through synergy benefits for the next 2 years?
So I think I had already answered this question. I'm just repeating it. At least on the interest front, we expect the savings to come of 50 to 70 crores. This is what we had budgeted when we had done the merger exercise. Now with interest rates going up, we're going to revisit that, but definitely it should be in the range of 50 plus crores on the interest front itself.
Right. Just wanted to understand operationally above interest, yeah. On EBITDA.
So operationally, we wouldn't see a significant portion of saving except for that ability to bid for large projects, doing projects where civil engineering, mechanical, all of them come together, and international projects exposure to a lot of civil businesses. Because given the growth trajectory, I don't think we'll see any savings coming out of reduction of manpower because we're right now continuously recruiting. But definitely we are aiming to just 9% for the current order book also.
Right. So how has been the margin variability across segments, the low margin segments and high margin segments right now, currently in the book?
So I think except for urban infra and railway, balanced businesses margins have been all in the range of 8 to 10% only.
Thank you, sir. All the best.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. The next question is from the line of Tina Virmani from Kotak Securities. Please go ahead.
Hi, sir. Thanks for taking my question. My question is regarding working capital. How do you see the payment situation from railways now? Has it started improving in the current quarter, or how do you see it going forward also because of some change in the methodology that railways had adopted, and so how do you see it going forward? And my second question is related to pledging as to what would be your plans for pledging action going forward.
So on the railway projects, yes, there were a few EPC projects where the payments were milestone based, which were back-ended. On those projects, now we have done more than 50-60% of work, and so payments are regular in nature. we do not see any difficulties in getting payments there. We had a few quarters where that had gone up, but getting into Q4 that would start reducing in proportion to the work done. So we do not see any challenges on collecting our receivables as far as railway divisions are concerned, based on whatever payment terms exist today. As far as the pledge is concerned, I think the visibility from the promoters is that the pledge is continuously reducing. They reduced something in the last few months also. And the belief is that it will continuously reduce over the period of the next 6 to 9 months. And in a manner that, the pledge is similar to what it used to be 3 to 4 years ago. We do not have exact numbers of reduction, but the message from promoters is that the pledge would continuously reduce.
Okay, got it, sir. My last question is regarding the breakup of order book in terms of fixed and variable.
So today, in terms of fixed and variable order book, it would be very different across various divisions. But in totality, if you look at it as an organization on whole on 40,000 crores, we might have closer to 55% which is variable in nature and 45% which is fixed in nature.
Got it, sir. Thank you.
Thank you. The next question is from the line of Bharat Sheth from Quest Investment Advisors Private Limited. Please go ahead.
Hi, congratulations Manish ji and Tripathi ji.
Thank you, Bharat. Thank you.
Completion of this merger. So going ahead, can you give some visibility in all of the segment that we are present, and how do we look at, from 2-3 years perspective?
Sure. So, Bharat bhai, I'll take the help of SKT also, and I'll request SKT to first start with water, civil infra, and some of them, and then I'll add on the other things. SKT?
Yeah. So, Bharat bhai, on the water front, there is a huge visibility across the country in most of the states. In fact, if I can quantify for the benefit of this discussion, only 30 to 40% of the opportunity has been opened up. Balance opportunities are yet to open in the other states to complete the water distribution across the country. So this is one spectrum. So next 2 to 3 years, we see good visibility. Coming to the BHF, there is a robust inquiry across all whether it is the IT spaces, residential. Of course, the area-wise, the challenges and problems, they remain. The NCR issues, Mumbai issue, and the stable South market, that dynamics remain. But there is no dearth of the opportunities. This is two. And the third is
just to add on the T&D side, if I divide this into domestic and international, as I mentioned earlier, Bharat bhai, domestic last 3-4 months we've seen a lot of traction, and even in the last 2 weeks there have been at least 5 or 6 reverse auctions conducted by PFCRC where we are on few projects with Power Grid. So that visibility in a few states and the entire Gujarat Rajasthan connectivity looks good. And with that, growing at 10% plus is not a challenge for T&D domestic. As far as international is concerned, you can see from our order book also that over the last month, we have won several orders and across the globe. We have won orders in Africa, we have won orders in Middle East, we have won orders in Latin America, we have won orders in CIS countries. So there is good visibility, and that business should be growing at 25% plus for the next year. As far as oil and gas is concerned, our focus is a lot more on international business. The domestic business does not look like growing very aggressively, but on the international business, we've now qualified for 6-7 countries in Middle East and Africa, and that's something which is a very exciting opportunity. Railways, as I mentioned earlier, while there is opportunity, but our focus is right now a lot more on closure of projects because we already have a very healthy order book there.
Okay. And just to add, Bharat bhai, the last one, the infra, though like we have said earlier, there is a big spectrum of the opportunity, but we are cautiously choosing where to pick up the project, and that is definitely one point of growth which remains. And whenever we get the opportunity, it is going to see a very good growth because that is the market which we are yet to address.
So Tripathi ji, in this infra, can you give, differently, say road, airport, as well as port side or something?
So, Bharat road, yes, it is a big sector in India, but practically we are not there, and we don't want to be here because it is overtly competitive. Metro, we are there, we are executing a project, we are looking more into the value-added project like going for the underground or something like that. So that opportunity, I think there is a good spectrum available and we will get in there. Third is the heavy civil kind of infrastructure projects like coastal road, tunnels or dams. There also now with this merger, we have the array of capability to address such projects of the large size and the large complexity. Hence, rather than attempting a 500-700 crore project in those heavy civil areas, we will be attempting the larger projects. This will be the strategy. Now, coming to the infra, if you look at in the Maldives, we are doing airport. That also is an infra project per se in the Indian context. So, as I said, in infra, it will be more based on the opportunity based. Where we get the right opportunity, we will chip in.
And Manishji, can you give some more color on this renewable? What are the things are happening and where there is a lot of gangos, but still on the ground, how do we see?
So, on the renewable side, we do not have a lot of presence in the solar business. We've taken one project in the international market, but we are not so much focused on that in the domestic market. As far as the domestic market is concerned, the opportunity more exists in the connectivity required for transmitting renewable to the grid. So that's where we're seeing a lot of projects coming up in Gujarat and Rajasthan. And that's what, is our focus area. On the domestic side, we are not so much focused on renewable EPC, whether it is solar or wind or hydro, any of them.
So my question was, Manishji, if say earlier in thermal power, when the thermal power order used to get released, T&D, because both takes around 4-5 years, or now whereas in case of solar, it is much smaller, EPC setting up the solar power plant is much a lower time frame. So how do we see, government working that evacuation should not suffer, so a transmission line has to be ready, say, which should be at least taking still 18-month time?
Sure. So Ajay bhai, what we have seen in the last 6 months is a lot of tenders being floated by RAC PFC to take care of the requirements in Rajasthan and Gujarat. We have seen tenders of more than 20,000 crores being floated by them across various projects, whether it is the Khavda projects or the Bhuj projects or the connectivity from Rajasthan to Gujarat. And I think those have now moved in a very active manner. Last 1 week, there have been 5 or 6 auctions which were done and won by different parties. So I think that clearly is a good opportunity for the next couple of years. And beyond that, I think this opportunity will continue to the other states of the country. Right now, a lot more focus on western states, primarily Rajasthan and Gujarat.
Okay. And simultaneously, these earlier we were working with, say, Techno Electric for the solar power plant for stabilization of power fluctuation. So in that space, are we doing anything?
No, I don't think we're working with Techno on any solar plant. We're working with them on a few substation projects.
Substation, sorry.
We now have got pre-qualification for majority of the substation projects in the country and overseas, and we continuously are focused on building that order book along with the transmission line orders.
Okay, and last question. See, there was one news item, this oil and gas pipeline that which we had gone, earlier to several people, L1 quoting bid at lowest, and now they were not able to complete. So government is thinking of rebidding in view of completing the grid connectivity. So are we able to get some kind of from that?
So, Bharat, we've not seen tenders coming out of that opportunity as of now. Whenever we see tenders coming out, definitely we'll be focused on that, given that, oil and gas, we are among the largest players in the country today.
So are we seeing, say, the way, earlier in T&D, the way of doing business, say technical qualification, then financial qualification, are happening any other infra project?
So we see that similar thing across various business units. Even oil and gas today, first technical happens, then financial happens. Even in water, some states we have seen that, first technical and then financial. So I think it's very different depending upon the state and the client as to what their requirements are.
Okay, great. And last question, with operating leverage in Q4, do we see some kind of improvement in EBITDA vis-a-vis Q3?
So, Ajay, we do not believe you'll see significant improvement in EBITDA because, current year we've seen volatility on everything with interest rates going up, which does not directly impact EBITDA, but on commodity prices, steel has again gone up, volatility in FX, volatility in aluminum and copper, we do not see it going up, but we're pretty confident of sustaining it in that level of 8.5 to 9%.
Great, and all the best, sir. Thank you.
Thank you. Thank you.
Thank you. The next question is from the line of Rajakumar Vaidyanathan, an individual investor. Please go ahead. So the line for you has been unmuted. You may go ahead with your question.
Hello, can you hear me?
Yes.
Yeah.
Go ahead, sir.
Yeah, thanks for the opportunity. Sir, just a couple of questions. If I look at your last quarter presentation, you mentioned that the top line will, you're given a guidance of 15% for the top line and PBT guidance of 4.5 to 5 for FY23. So I just want to know, do you still maintain the guidance? Because I see that slide is not there in the current presentation.
Yeah, on a standalone basis, we still maintain this guidance for the current year. On a console basis, we have revised the guidance slightly lower to 12 to 14% instead of 15% for the current year.
And how about the PBT?
As far as PBT margins are concerned, we would be in the range of 4.5%.
Yeah, because you have done only 3.9 for the 9 months, so which means your PBT should go by at least 2% in the last quarter, to maintain 4.5.
No, so on a standalone basis, I think we are targeting to be in a range of 4 and 4.5%. If you look at it on a standalone basis, if I look at 9 months, we are at 5.2% already on a standalone. On console, yes, it's slow. So standalone, we believe we should be in the range of 4.5 to 5. Console, we might be in the range of 4 to 4.3%.
So it's lower than what you guided in the last quarter.
So standalone, we are at the similar levels.
No, but I think the last quarter guidance was on console basis.
Okay, so console basis, yes, margin could be slightly lower than what we believe. It could be more in the range of 4.2%. Because in the current quarter, we have had surprises coming out of Brazil and Shubham in terms of losses. Brazil, we have booked losses of closer to 12 crores in Q3, and Shubham also has shown losses of around 6 to 7 crores. So this is something which were slightly surprising. We knew there would be some losses. We believe Q4 would also be a challenging period for both Brazil and Shubham, and that's why slight reduction in the margin as far as the console margins are concerned.
Okay. And any one-off expenses booked in current quarter on account of mergers?
No, I do not think we've booked off. It might be some legal expenses, but nothing significant in terms of impact on profitability.
Okay. And sir, any reason why you're not upping the PBT guidance even for the FY24? Because you're still saying PBT will be in the range of 4.5 to 5. So despite having a 20% revenue growth, there are no scale, and you said that synergy benefits of 100 crores is going to come. So even with that, you are still maintaining the same 4 point, the lower end of the guidance, what you guided in the last quarter.
So what I said on the call was that we are still working out a detailed business plan. Our current estimates look like we should be in the range of 5%. And we will come back with a definite number or a range of numbers by when we do our year-end numbers. As of today, our biggest challenge continues to be volatility, right? Whether it is on FX, whether it is on aluminum, copper, steel, all of that, right? we do not want to get into a situation where we target something which is not achievable. So we believe that we are pretty confident of 4.5 to 5, and we'll come back with a revised number when we give the year-end number.
Okay, great, sir. And last question, sir. So are you not seeing any softening of the raw material prices yet in the P&L? Or you expect to see some benefit in the quarters to come by?
No, we're not seeing major softening in the raw material prices. Whatever happened, it happened last year or the first quarter of the current year. Now we've seen steel also going up last 3 to 4 months, and you've seen aluminum has gone up again. So we're not seeing major softening in any raw material prices, except cement, which was soft for maybe a quarter or so. But otherwise, there's not a big impact of softening of commodity prices.
Okay. Okay, sir. Thanks a lot, sir. All the very best.
Thank you. The next question is from the line of Akshay Kothari from Envision Capital. Please go ahead.
Yeah, thanks for the opportunity again. So for this quarter, there was an improvement in our gross margin as well as our subcontracting expense increased. So what was the reason for that?
I think the subcontracting cost, just to answer that, is primarily driven by a mix of project revenue, right? It's not driven by, you cannot look at that in isolation. On a quarter-on-quarter basis, it is some projects which have more subcontractors, some have your own gang, some has more supply and all of that. So subcontracting cost is driven by a mix of projects which happen. As far as gross margin is concerned, I think we are at a similar levels of what we had guided, right? There's no big surprise coming out there.
There was sort of improvement, I'm saying. So
yeah, so I think it's as I said, it's improvement as compared to what? You're looking at improvement compared to our guidance or compared to what you saw Q2 or previous year Q3. We are targeting ourselves more on a guidance, and there we are seeing that we are in a similar range.
Okay. So in terms of commodities, what would be the major commodities comprising in our material cost?
I think it would be, if I have to, without quantifying it, the largest would be steel, followed by aluminum. Steel in the form of both structural steel, rebar steel, plate, shackles, all of them, followed by aluminum. The third biggest would be copper and zinc in a similar form. And cement would be important. Yeah, cement would again be a big component. DI pipes will be about. That is steel. That is steel. Pipes is a part of steel.
Okay. So what is the 9 months capex number?
We have done capex of closer to 500 crores in 9th month. So that's an important area where we have revised the targets from the beginning of the year. While we had budgeted for capex of only 250 to 300 crores at the beginning of the year, we revised it upwards during the year, given the order book visibility and the growth happening. And we have done closer to 500 crores, and we believe that we should be at levels of 550 crores by the year end.
Okay, so but I think a lot of it is not capitalized since your depreciation has not increased. So is it going to capitalize by the year end?
Yeah, you'll see a lot of capitalization happening now. And again, a lot of assets are more in the range of heavy equipment where, the depreciation rates would be anywhere from 8% to 12 or 15%. It is not in the nature of shuttering material where depreciation impacts immediately. But yes, a lot of capex is happening while we speak.
Okay. And sir, if I refer to the previous on calls, we were more bullish on the international T&D and water projects. Now we see that we are also looking towards good domestic T&D ordering. So what's apart from the budget guidance, what's actually changing on the ground? Just wanted to know that.
So I did explain this in the call here earlier also. So just to re-clarify this, we continue to stay bullish on international T&D, water as well as B&F as a core business of growth for the next 2 years. Domestic T&D, last 3 months, we've seen a lot of traction coming from orders in Gujarat and Rajasthan, primarily for the entire renewable connectivity capacity. We're also seeing some orders coming in southern India. These were all orders which were scheduled to be coming in Q1, Q2 of last year. But due to some regulations issues at Rajasthan, all these orders got deferred. I don't know whether you remember there was this bird issue in Rajasthan which went up to NGO, which went up to Supreme Court level. Yes. So a lot of things got deferred by 6 months. These orders have come up now in the last 3 months, and that's something which we believe will help us push our growth in T&D domestic for the next few years.
Okay. And Ladakh also 20,700 crores has been allocated in budget, but I think there are some protests going on in Ladakh. So any on-ground movement happening over there?
To the best of our knowledge, we have not seen much happening at a tendering stage. If there's something happening at a developer or a regulatory or a strategic space, I wouldn't be aware of that.
Okay. Okay. And what sort of market share can we expect from that Ladakh order?
I think we would be happy to answer that question once the tenders come. As I said, there's no visibility as of now. So as and when we see the tenders, we'll be happy to. We've been in the T&D space, we've been having a market share of 15 to 20% over the last 10 years. So hypothetically, it's good to imagine that we'll be in a similar space getting into the future.
Understood. And lastly, do we have any exposure in Turkey and the affected area?
No, not to the best of my knowledge. Let me check with the team now. We're procuring something. No, nothing. Absolutely nothing. We don't even have any of our employees on holiday there. So we are okay with that.
And has there been an increase in our working capital cycle?
So if you look at typically working capital cycle, you see that going up always in Q2, Q3. And you see that history happening every time over the last 5 to 7 years. Yes, they've gone up by 7 to 8 days over this 9 months. We expect that to reduce slightly in the next 3 months. But yes, we've seen that going up, primarily driven by growth and a lot more focus on execution of both domestic and international projects.
Okay, so how much do you expect it to come down in next few months?
So we were on working capital in terms of number of days. I think we were at around 126 days at the beginning of the year. Now it's come to 134 days. We would like it to be back in the range of 125 to 130 days.
That's great. Thanks a lot and all.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. The next question is from the line of Abhineet Anand from MK Global. Please go ahead.
Yeah, first on the road BOTs, what is the 9-month support? I think is 60 crores. So what is the support expected in full year FY23 and 24?
23-24, we may be with the, we have a repair, O&M repair cycle which is going to come. So we should be in the same range of 50 to 60 crores like this year. Marginally maybe 10-15% difference depending on the traffic, but I think whatever the upside was to come, it has come in the traffic. Every year we will not see this growth. But we have a O&M cycle coming up in the project because most of the projects, they are on the 8th or 9th year of the post operation and we have to put some money to. So that way, same kind of infusion we have to see.
Okay. Secondly, with this standalone, both the entities being merged, can you give some balance sheet data points like network debt, fixed asset, working capital and all?
So I think it might be helpful for all the details that if you can get in touch with our team members, Kunal and all of them. We've given the working capital days. The debt numbers is already known, the net debt which we've already shown in our presentation. But if you need details on gross fixed assets, net fixed assets and all of that, it might be helpful if you can get in touch with our team. Kunal's number or Vishesh's number is there. You can just get in touch with them. They'll be happy to provide you that.
Sure. So, secondly, from Indore, what can be the inflows in, let's assume in F24 that happens? What could be the inflows from Indore?
So on Indore, for the current year, we budgeted an inflow of closer to 100 crores, out of which in the 9 months, we've got closer to 55 crores. So we expect around 40-50 crores to come in this 3 months. After this, getting into the next year, we expect the balance of around 150 crores to come in 23-24.
Okay. And lastly, you did mention that in the capex side, it's higher compared to what you have budgeted. So I'm assuming that for next year, 24, those numbers would normalize to 200 odd crores. Or are there any other plans?
I think we should be targeting capex back to the normal levels of 200 to 300 crores. and we will come back with the exact number once we finalize the business plan for next year. But you're right, it wouldn't be as high as what we have done in the current year.
And given this, synergy in terms of both companies, any sector or subsector that you guys are evaluating as to where at a combined entity we could have been, but because we are working as a separate entities, we have not been doing. So any sub-sector that you are targeting to, bid in the future?
I think we continue to be focused on the 6-7 sectors where we exist today. Our only strategy change would be we'll be bidding for projects of much higher value, which involve complexity of design, engineering, pre-build, all of that. So we would be focused on larger projects with design and engineering requirements also.
Thanks, sir. Those were my questions.
Thank you. We have the next question from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yes, sir. My question is on Sri Shubham. What has been the support given till 9 months for Sri Shubham Logistics?
Parikshit, on the financial side, we've given them zero support. There's been no financial support given to Sri Shubham Logistics in the last 2 to 3 years, in like 2 years definitely. Zero support to Sri Shubham in the 9 months. In terms of
okay, but how are they funding their losses then? Because you said this quarter also there was a loss.
So if you see the numbers of Sri Shubham, they've exited a few, they have sold a few assets on cold storage which were not giving very good returns, and those assets have helped them to make sure that the debt reduces, and that's also helped them on the cash flow. So with the current visibility, we do not see any support getting into the Q4 also. If this MSP, the minimum support price versus the market price continues to be as high as what we see today, then there could be some requirement in the next year, but we would be in a position to budget that only at the beginning of the year. Our biggest challenge in Shubham today is that the market price is so high compared to the minimum support price that all agriculture across the country are at less than 50% capacity. Primarily on wheat, we have seen that prices go up significantly because of the Russia-Ukraine war. And because of that, you see that even FCI stocks, which is public data, you'll see is at a 20-year low. They're sitting on a buffer stock which is less than 1 year. So with this, clearly there are challenges in terms of warehouse utilization at Shubham, and which could further result in challenges of some small cash flow requirements into the next year. We will review that and come back to you at the beginning of next year.
Okay. And just one last question to escaping on the roads portfolio. So you did mention about the restructuring of the asset. So the losses of about 50 to 60 crores of funding support for next year. So how do you see it in the light of this restructuring happening?
So restructuring. So I think from a restructuring perspective, even if the restructuring happened, would there be a significant difference? Maybe 10-15 crores reduction could happen in year 1. It might improve from year 2 onwards. So even if restructuring happens, we still believe that 50 to 60 crores of inflow might be required for next year. But as SKT highlighted earlier, maybe 30 to 40% of that inflow would be for major maintenance. Last 3-4 years, majority of our support has been only for debt and interest repayments. But next year, given the revenue growth, a lot of debt and interest repayments will be taken care by the respective projects. But we might have to support them on major maintenance, which happens once in 7 to 8 years.
Okay. This last thing, so you said that you appointed some consultants and back on the monetization. So do you think it will require a significant haircut even post restructuring for this thing to go through? So there could be some more non-cash losses which may come in.
Sorry, I missed this question completely. Can you say it? Okay, sorry. There wasn't clarity. No, we've just appointed, we had earlier also appointed consultants to look at this BOT asset. We have again reinitiated this exercise just a month ago. All these exercises do take time, and hopefully next 2 to 3 months we might have some clarity. We believe that the market is bullish in terms of looking at projects which have a lead of like next 10 to 15 years, and that might help us sell this assets. We've already declared this assets as non-core. So from our perspective, if there are good buyers, we would be happy to exit this assets at the earliest.
And this Kurukshetra is now out of our books. Nothing, we have nothing to do with, because we mentioned about 2 crores this provisioning was done. So do you still have any residual interest or any litigation or any liabilities pertaining to that project, or it's now being maintained and handled by NHAI?
I have not got the question.
So on Kurukshetra, we had a small loss out of some payment to creditors and statutory payments. We do not expect significant inflow to happen. We're completely out of that project. NHAI is now tolling that project for closer to last 8 to 9 months.
Yeah.
We have initiated arbitration with NHAI on Kurukshetra. The arbitration proceedings are on, and we expect that by Q2 or Q3 of next year, we should have the arbitration award on Kurukshetra.
Thank you, sir, and all the best. Those are my questions.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. On behalf of Emkay Global Financial Services, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Thank you, everyone.
Thank you. Thank you.